Good day, Brent Ritchie here. Hope you are doing well. Thank you for joining us. We're excited. We got a fantastic opportunity here and a very small dollar amount left. And so let's jump in and excited to go over this with you. We love this product. We love this project. The community here is just fantastic. Definitely feel like it's just one of our golden children here. Cottage on Edmonds project in Lewisville, Texas, which is kind of the Dallas Fort Worth. Almost if you took the middle of Dallas and Fort Worth, go a little north, that's where we are. And it's just nestled in this really nice demographic. So it's more of a residential feel. And we've had the ability and the opportunity to serve these residents and make it better, improving their living arrangements, bringing some great amenities. And that is kind of where this opportunity is. So you might ask, what is the opportunity? What does it look like? We're going to jump in. So glad you asked. Right before we do that, there are some disclaimers. And so we're going to go through line by line. We're not actually going to do that. That would be painful for you all, but this will be available for you after the presentation. You can go through, read through, understand risks of any investment. And so this is for accredited investors only. Generally, those are three criteria. The main three are you've made 200 last 2 years, anticipated to do so moving forward, 300 as a family, or $1 million net worth, not including your primary residence. So that's in general the SEC's qualifications for what an accredited investor is. And so this opportunity is for accredited investors only. And if you look, we're going to be talking about some forward information, expect and anticipate. Obviously, we do not know the future. And so these are things that, based on leading industry data, based on knowledge of the market, experience in this market, we anticipate kind of where things are going to go. But with all that being said, this will be available for you after you can read through, understand the risks of any investment. So let's jump in. We're going to go quick overview, like you said, like I was talking about, kind of what does that look like for us, our team, operations, the market, what's our plan forward and next steps to get involved. So if you're my brother, these are the things I tell you. My brother will probably actually watch this. I'm going to make sure he does. And he is also joining us on this investment, along with a lot of good friends, family. And so we hold everyone's money higher than our own. And so that is our first is wealth preservation, then wealth growth. And I think we got a great opportunity for both here. And so we got a nice stabilized project that's already shelling off lots of good money. And what we're looking at kind of is coming in towards the end of our year 3, probably gets another 2 to 3 years is our approximate time frame for the rebound and sale of this asset. So what does the equity required look like? 575,000. We have approximately half of that committed right now. Hold time is 2 to 3 years. Average cash on cash. So we're going to have distributions starting next year, likely end of Q2. That's going to average 5.4 over the next 2 years. Anticipate selling at the end of 2026. And we anticipate the market to be about a 5 cap at that time. We're already seeing 5.5, 5.25 on these type of deals. And so I think that's pretty realistic. And what are we looking at for an investment? For your investment, looking approximately a 20% return. If you take that time frame, internal rate of return is about 16.9, so really strong. This project is nestled in this beautiful little pocket, high demographics. You can see here, 81.9, 97.8 in the median household income in the 1 and the 5 mile. So those are really strong. We love that. Tons of job growth, tons of population growth, people moving to an area. If you're saying, hey, Brent, what do you like about this? We know this asset well. We've seen the top of the market. We've seen the bottom of the market. And now we're seeing the rebound already. So a lot of job growth, a lot of population growth, a lot of people moving into this area is kind of why CoStar, which is a leading industry data source, is showing, hey, 3.4, 4.3, 3.4 growth over the next several years. And so we'll see that. This is an 80-20 split on the investment. Investors get paid first before it goes to the sponsor. And there's a 2% asset management fee overall. So our team has a track record over 4,100 units over multiple states, 25 plus years combined experience, and over 2,000 of those within Texas. Myself, recovering civil structural engineer, experience managing a lot of global projects and a lot of fun in that. And so 2017 migrated over into this commercial real estate space, full time in this space for the last several years, and really love the opportunities that we can do and create. So we've managed. I've been fortunate to be able to manage, own, and operate over now 3,800 units. My partners, I got great partners, Manoj, Bobby, and Sanjeev. Manoj with his MBA, strong asset management, underwriting, negotiation skills. And me and him kind of work lockstep on this project. Bobby, great business owner, friend, and just has a lot of expertise and knowledge kind of on the business side. And Sanjeev as well. And so between myself and Sanjeev and some others, we've had some good exits on this. And you can see, some great full cycle deals. What have we done so far? Again, I'll try to make this short bridge. You'll be able to go back. We've added a beautiful clubhouse. We've done kind of renovations. You can see there 3 levels, platinum, gold, silver, and all the renovations we've done. Added some covered parking, relocated the office, some car care centers, smart package centers. You can see some of the upgrades here, what it was before, what we've done. And we even have multiple that are granite countertops, undermount sinks, gooseneck faucets, really, really nice units. What is this opportunity? Kind of why are we having this conversation with you today? And what is the need moving forward? So if we look back, September 2021, that's when we got the project under contract, closed in December. And so as we were looking through everything, negotiating everything, the anticipation at that time was still this blue dotted line on the bottom. This is the FOMCs, the Fed's anticipation of where interest rates would go. This blue line is kind of market anticipation, right? And so mid 2023, Fed's still saying nothing, no growth. Even in November, they said they're not going to have any changes. And the market was kind of baking in, forecasting about a 1%. What happened? You all know what happened. Early 2022, we saw the fastest increase in interest that we've ever had in history. So we've never had anything go up that fast, that quickly in history. So what did that do? Interest rates went up 2.4 times. Caps grew 48.1 times higher, right? So that's over $1 million more than what it was when we had the property under contract. So obviously that caused constraint because where is the money coming from? And so let's go through. You can see, okay, this is kind of when we close. If we stuck with the Fed's anticipation of where rates would be, we're paying this amount. And then, but we bought something called an interest rate cap. So our starting around 3.75% was our rate. If rates went above 1%, then it locks us in. And so that puts us around 4.75. And so when the rates did eventually go up, thankfully we had a rate cap that blocked the additional cost, saved us over $1 million. We still had that additional interest of 367,000. And then enter in kind of second half of this year, the sponsorship team put an additional 120,000 to make sure we keep a very low cap, low interest rates, and have extra surplus. So that's kind of rates. So fortunately, we were able to kind of escrow additional net income over 700,000 that went towards paying for those interest rate caps, especially in the third year. But as we go to the fourth year, fifth year, there's going to be interest rates are still high. We've seen a 50 bip, 0.5% drop. And we're anticipating there's another November meeting, December meeting where there's additional cuts to be made. So we just anticipate some additional cuts, which will help everybody. Where are we today versus where do we anticipate? August, you can see income, we're up 3% what we anticipated. Expenses, we had some major hits. Anybody in this space can know and feel insurance, right? Insurance has skyrocketed. That's been a huge factor. Taxes as well. We usually tackle those, litigate those, come back down. Overall, NOI about 8% less. As we actually get our September financials, and they're being finalized right now, we actually exceed our target for the end of the year. So we believe September, October, November, December, we're going to be not only catching up to this target, but exceeding, which is beautiful. So that is our net operating income. So what happened in the market? So we had 2021, we got the property under contract. You can see here, this is CoStar. CoStar, again, is that kind of national data analytics source a lot of owners and operators, developers rely on. You can see we had fantastic rental growth. But as the interest rates spiked, you still had a lot of development that was in that pipeline getting delivered. And so you had that too much supply being delivered at that same time. And so here you can see, rents really plateaued, right? Instead of having some growth, now you plateau and you actually dip a little bit. But now as we come, time of this recording, we're going to be coming up to 2025 here shortly. You can see a little bit of growth in Q1 and then Q2, 3, 4, right? Some great growth coming down the pipeline. So 3.4, 4.3, 3.4, 3.2, and overall, some good stabilized vacancies in this submarket. So we love that. That's really strong. Quick snapshot of kind of where we are today. So Y'all Street, some people call DFW, Dallas Fort Worth, second largest financial hub next to New York City. And so you've seen a lot of headquarters move from New York to Dallas to Texas and to Florida. Definitely that net migration out of New York. But here's a property nestled in this beautiful little residential area. Great school district. You drive around and you see, some great, actually, we're going to be coming up to that next slide. So very low supply, high demand, and we love that, right? So property is right here, Cottage on Edmonds, surrounded by a bunch of churches, Starbucks, just a lot of great both jobs, and just nice neighborhood, very affluent. You can see both, you got medical, you got corporate headquarters, a lot of Class A jobs, Mary Kay, AAA, Sabre Holdings, Verizon, Citigroup, lots within this immediate area, which is that continual driver. And so if we look at where we are today and where that growth is, you can see, anticipated population growth about that 5.6, but with low supply, and you look at here on this bottom left in this orange curve, very low supply in this submarket. And so those are things you love to see, and great opportunity. You can see the neighboring areas, just very high median income. And so those are strong, and that's US Census. Where are we at? Where are we looking? What are our options on the table? So glad you asked. So again, need an additional 575,000 in equity. And we'd anticipate in this first option, which is going to be extending the rate cap in our year 4, year 5, extending the rate cap, selling the property at the end of year 5. So what does that look like? Projected return overall around 20%, 16.9 IRR with an average cash flow of 5.4. So really strong. If we do a couple of different stress tests, what happens if it's just a 5.5, right? Say what happens if the market softens, next year and the following year? You can still see a very healthy return, 12.1%. But hey, if things go to a 4.5, which a recent CBRE report was showing, you could see a 28.8, just really great numbers. So sources and use, what's that look like? Again, additional equity using approximately 133,000 from year 4. You got the cost of a 1% strike, your lender extension fee, strike in that 5th year at 2%. So allowing it to go a little higher because that'd be our final year of sale. And then the lender extension fee there, along with some contingency costs. So that's about what we'd be anticipating in this market. Hope you guys like that nice, strong Canadian about. So overall, looking at a 5-year plan, we did account for additional expenses. Here we got that money that we'd be using from net income. Still a good, strong cash flow distribution. In the year 5, buying a higher strike, right? So letting interest go up a little bit higher. And so that's where you see that delta in the debt service payments, but still, 5.0. So that average is about 5.4 on your distributions. Second option, what if we just get rid of this bridge debt? What if we just switch to fixed rate? Look at this model looks at, okay, let's look at switching to fixed rate. Maybe we got to buy an interest rate cap for the first little bit of next year while we switch over and everything transitions. And so what does that look like? That looks like here, still a pretty strong return, right? Not 16.9, but we're still talking 16.1. So that's very healthy. 322%. That's, remember, your additional time. So the IRR adjusts for time, but still really strong. And so what does that look like? So again, we have the additional 575,000 coming in, net income from year four, approximately 262,000. And so we have a first half of the year interest rate cap at 1%, lender extension fee, that would be the same. Cost to switch to agency is around 2.5% of the loan balance, which is about 411,000. And then just having some additional contingency of 150 in this option. So in stretching this out, remember you're switching to fixed rate. So now you can't sell as early because you gotta your prepayment penalties, the cost to get out of that debt is more expensive. And so here you go, increase in expenses, this additional cost from net income for that fee. And then we're going to have some additional CapEx expenditures as you hold the property longer. And so that's what that 250 is taken into account. So overall, if we look at both options, they're good. They're strong. We like them. Option A complies with our existing business model. And it also the IRR return is really strong. So we like that. Very low exit fee. If the market rebounds quicker, maybe we can sell sooner. And then the ability to switch to fixed rate. Hey, if something happens, there's a little bit more chop in the market or things go differently, then we get the ability to switch to fixed rate. So that's something why we love that. Really want to make this condensed, short, sweet for you guys. So we're just going to go quickly here. We love it. It's a strong market. We know it, right? We've owned it. We own it today. We know what it's like, and we know, just the tenant demographic here. High collections, low delinquency, strong demand in this. And really now we've kind of been through the bottom. We've been through all the choppiness, and we see around the corner, both from industry data and just knowledge and what's happening, week to week of an increase. So that's really what the opportunity is. Approximately 20% average annual return a year. Around that includes 5.4% distributions, hold time 2 to 3 years. On a refi or sale, investor gets paid first before the sponsor gets the 80-20 cut or the 80-20 split. And again, we're only accepting about 575,000. We have about half that already today. And so we anticipate that next half to go quickly. Minimum investment is 50,000. We are now open, excited, and it's going to close once it's fully subscribed, once the funds are in the bank. And remember, this is for accredited investors only. Let us know how you're going to hold the investment, IRA, QRP, trust, what that looks like, cash. So let us know how much you'll be investing. We're sending you this link. This recording is going to come with the link. Again, trying to make a condensed version. Complete your investment documents and wire your funds within 72 hours. So for those that are new, we do monthly communication. We're open, transparent. We include the financials. And so you're going to see everything as we go. Distributions anticipate to start about Q2 next year, at the end of Q2. And again, we're here for any questions that you have. So I think we answered that second question. It is a bridge loan that we're in right now, 3+1+1. Our extension's coming the end of this year, and that would give us, with that first extension, second extension, bringing us to the end of 2026. So that's it. Hope you're doing well. Look forward to hearing from you. We'll talk to you soon.